Hey guys, Whitney here. Welcome to the Passive Investing Made Simple Masterclass. I'm your host, Whitney Elkins-Hutten. I'm the Director of Investor Education here at passiveinvesting.com. And this is the show. We do it live every Tuesday to help you learn the ins and outs of passive investing and just like the world of financial knowledge that you probably maybe should understand when you're getting involved in passive real estate. Anyways, if you haven't already, check out passiveinvestingwithwhitney.com. There you can get access to my calendar. We can talk all things passive investing real estate. You can see our open deals and also get my free ebook, The 7 Steps to Being Involved to get you into your first or next investment. Now, today, I am so excited to be joined by Mark Yege, Wealth Architect Podcast. I was on his podcast a few months ago, and we just got into this amazing conversation around money, the Fed, the volatility of the dollar, where are we, where are we heading? And I was like, I've got to bring Mark on the show. Now, guys, as you know, this is not an endorsement for services. However, Mark is brilliant in this area, and I just want to make sure that you guys have a good understanding, the good, the bad, and the ugly of where we're at today in today's market. Now, Mark, before we get started with all my questions and our listeners' questions, tell us a little bit about what you do and how you got here and where you're at today.
So what I do is I'm basically a financial education kind of guy. I'm really passionate about helping people understand money, whether that's they know nothing about money and they want to become wealthy, or they're 11 figure, 7 and 8 figure investors, they want to become even wealthier, or they want to just enjoy their life. So that's kind of what I do. I've been doing it since I was 12. Obviously haven't been helping people, learn the investment side, but I've been investing since I was 12 when my dad taught me how to invest. And I also run a couple of hedge funds. I have a Bitcoin fund, a couple of funds on that we do. We create income from the stock market. And then those people that don't want to be in my hedge funds, or since we're closed right now in our hedge funds, I just teach people how to do what I do. It's a lot of fun.
Awesome.
Yeah.
Well, like I said, I was super impressed by your background and not just understanding of all these things that are happening in today's environment. But let's kick it off. Like, where are we at today? Like, where's the Fed at? What is the current status? What is the current policy? What should passive investors be looking at right now when they hear the word the Fed?
Well, in my mind, the Fed has a lot of connotations, and a lot of them can be bad. And it's funny because I'm over in Greece right now, and I do a lot of motorcycle riding when I'm here. And a couple of weeks ago, I was re-listening to this book called The Creature from Jekyll Island, which, if you haven't read it, you got to read it. It's all about how the Fed was created in secrecy in 1913. So you probably know where I'm going by telling you just the word secrecy. And here we are more than 110 years later, and there's still a lot of secrecy and a lot of stuff that we just don't know. The Fed is the most powerful entity in the world. The one dude that runs it is a 69-year-old lawyer. Don't ask me why he's not an economist, but hey, economists don't have all the answers either. And so we let this one dude control everything that goes on in the money, and they usually do a pretty bad job of it. And a lot of times what they say is exactly the wrong thing. And if we listen to them, sometimes they get it right, or we think they get it right, and we get it right because we listen. And sometimes we get it totally wrong. So in 2021, Jerome Powell, the Fed chairman, came out and said, "Don't worry, everybody, inflation is transitory." Well,
what does that mean? Like, what does that mean for the average doesn't understand?
It doesn't count. It's all good, just like a blip. And it wasn't a blip, as you know, if you buy eggs or cars or steak or life, things are expensive. They're more expensive, and they're not going down. So instead of your eggs going up 50%, maybe they're only going up 30% per year now. And so the Fed's like, oh, well, inflation's, coming down, but it's still compounding. So it's getting worse. And they knew that, right? You can't throw this much free money into the world and expect prices not to go up. So for them to come out and say inflation is transitory, I was sitting there going, no, this is what we've been waiting for. This is inflationary, and we're not going back. There's a whole group of people, and I'm going way beyond your question, but there's a whole group of people that think, oh, well, now that we're pulling back and the Fed is raising rates, we're going to go into a disinflationary cycle. It's not going to happen. And it's not going to happen for a lot of reasons. The biggest one is because we're in a debt spiral. So we are almost $32 trillion in debt. And a lot of that debt gets refinanced at now the higher rates that the Fed just raised it to, Fed 5.5 Fed funds. And so instead of paying 1.5%, and I just did a podcast on this, but instead of paying 1.5% for our money, now the Fed is paying 5.5% for the money. And so as we continue to spend in Washington, and we don't hear anybody talking about cutting spending anymore like they used to, we continue to spend in Washington, and then we continue to refinance that debt at a 5.5% rate, which is like 3 to 4 times what it was just a year and a half ago. The cost of debt is about $3 trillion a year, which is $9,500 per family is what it's going to be in about 10 years. So your family is going to have to make $10,000 just to make the interest payment on the debt. So let that sink in. And it's getting worse, right? So now, we keep spending more money. So the debt goes to 32 trillion. And then we have to print more money to pay for the debt because we're not fiscally responsible about it. Or we have to tax people more. So they're either going to come after you and have you pay it in the tax, but it's a lot more politically expedient to just say, well, let's just let inflation go up. That's a hidden tax. Nobody blames us. Just things are a little bit more expensive, but they're going to have to keep printing more money. So it's going to get more and more inflationary. This is what happens at the end of all of the fiat currencies that I've ever studied, which is over 700 fiat currencies in the last couple thousand years. So.
Oh, I don't want to let that last statement slide, the end of a fiat currency. Okay, so let's put a pin there because I'm not ready to go there yet.
Okay.
But let me kind of sound this back to you. So what I hear you saying with the monetary policy that's currently in place, either let inflation roll or, tax everybody. We let inflation roll, it's compounding. So while year-over-year numbers might get quote unquote better come July, now you're compounding whatever that your number is over what happened in the past 18 to 24 months. Is that what I'm hearing you say? So
absolutely right.
We're not going to go back the other direction. Now, I want to, before we move on, because there's so many rabbit holes we can dive down here, and I want to try to kind of keep, get to the part where we help limited partners here, passive investors, understand how to mitigate this with their portfolios. But before we go there, why do you think, what are some of the key things with the Fed's monetary policy that lead you to believe that we won't have that deflationary environment? Why could that never be entertained?
Well, it's like, I watched a show a few years ago, and it was about these guys that had their whole garage set up with clotheslines. And what they did is they went to their printer and they printed out $100 bills, and then they used hairspray to fake those little markers to make those markers think that they were $100 bills. And so they were printing all this money. Well, they got caught. So you can't have something for nothing. Like you and I can't go out and print our own money. We can't spend more than we have, but the Fed does that. When it does that and people have money sloshing around their pockets, they're like, hey, I got a little bit extra money for that coffee. I don't mind spending $6 instead of $5 for my coffee. I don't mind spending another $100 for my airplane ticket. Hey, cars are more expensive now because of supply chain issues, which is not really why they went up, but it's a part of the narrative. And so people are like, well, I need a car, so I'll spend an extra $5,000. So you've got two parallel economies going on. You've got, and I'm going to call them the poor, but it's anybody that's not really, really rich, right? Anybody that's not really, really rich has to have food. And if like all of the extra money that you have is going to spend at the grocery store, you don't have extra money to invest. And then everybody else that has extra money to invest, if you invest in hard assets, those prices are going up, and that's a good thing. So the answer, to get back to our limited partner conversation here, is if you're in hard assets, right? If you're in real estate, if you're in gold, if you're in Bitcoin, which we can debate whether it's a hard asset or not. If you're in stocks, if you're in things that are asset, the traditional asset classification, you're benefiting from all of this inflation, right? Are you really? I don't know. The cost of living is going higher and the money is whatever, but your assets are going up in dollar value. They're not going up in utility value, but they're going up in dollar value. So you've got kind of two parallel economies. You've got the tax on the poor that can't afford this stuff. And then you got anybody else that could put money into hard assets. So what's the answer? Put money into hard asset. Whether the Fed says they're going to raise rates, whether they say they're not going to raise rates, doesn't matter. I believe they're over here with the little fake monkey going, hey, look at the silly monkey, while over here, they're printing more money. And they're not telling us maybe overtly how they're printing more money. They're bailing out banks. They're printing money to pay for the debt. And I don't think we're getting a fair shake from the Fed. That's my story, and I'm sticking to it.
I mean, okay. So let's pull this back to kind of a more tangible example. You're in Greece right now.
Mm-hmm.
For anybody who's not a historian, what happened in Greece?
Oh my God, great question. So, and this is going to happen, maybe you earmark this episode with Whitney here, but it's what in 2013, they had what are called capital controls. And so the economy was spiraling out of control. It was recessionary. There was all kinds of unemployment. It was at 25% unemployment. And they just couldn't handle their debt anymore. They were raising taxes, but they couldn't raise taxes anymore because 3/4 of the people were working and only 25% weren't working. The other people were all on the dole because they retire at 59 here. And if you're a hairdresser, you get 60 grand a year in, pension. So like everybody wants to retire, and then they live a long time over here. So they just couldn't afford it. And they don't print money in Greece, right? They have to go to the European Union, and the European Union's like, okay, well, you got to cut this, this, and this, you got to cut that. And so the Greek system basically collapsed. And so what they did is if you had a bank account, they froze it. And they said, you can get $400 out. I think it was a month, it might be a week, but they said, that's all you can get out is $400. 400 euros, right? And so imagine having $10,000, $20,000, $100,000 in your bank, and they go in and say, you can't access the money, you can't wire it, you can't buy a house with it, you can only take out $400. It's called capital controls. Worse yet, if you look at Cyprus, which is kind of related to Greece because it's half Greek, the Cypriot economy totally collapsed. And they did what are called, they kind of, I can't remember the name of it, but they endemically seized your money. So I had a friend of mine who had $100,000 in a bank, euros in a Cypriot bank. And they said, hey, thanks a lot, but it's our money now. And we'll give you $30,000 for it and $70,000, euros, whatever, same thing, of our worthless bank stock. So that if we ever do come out of this crisis, at least you own the bank stock. So here we are 10 years later, there's $30,000 in the account and there's worthless bank stock. So they stole 70% of my friend's money. That's coming because we're not going to be able to pay our debt. So they're going to come in and they're going to try to attach in different ways wherever anybody has any assets and any money.
And you're saying that for the United States. I don't like to be a doom and gloomer because I feel like it has to be like some way that we can protect ourselves. So guys, if you guys are listening, you're like, Whitney, where are we going with this? It's moreover like we need to recognize reality, what is here, and then we can start figuring out with ways to tangibly work through this. And so,
and I don't want to be a doom and gloomer either. I want to be somebody that's like, hey, look, this is all the stuff that I've seen in my life and all the things that I've studied. And you know what? It probably won't happen. But if it does, can you be ready? And I had a friend of mine today that's like, he's been short the stock market for like 3 years. And, there's a guy named Harry Dent who's been short the stock market for like 20 something years. And, every once in a while, the stock market does crash, but you can't bet on that. But what you could do is hedge for that. I'm in the hedge fund business, so I kind of know that you've got to kind of play the rainy day card a little bit. So here's what you do. You understand like what we're doing, having conversations like this, understand that there's a lot more to the economy than what we hear on TV. Study what's going on at the grocery store, study how much your martini costs, your car costs, listen to what they're doing, buy hard assets, right? Real estate is a great asset, especially if it's cash flowing. Buy a little Bitcoin because and I don't say buy it as an investment. I say buy it as an insurance policy, not with all your money, it's a little bit of your money. Buy a little gold And if you have hard assets, you're going to be hedged against the normal inflation that probably should happen if we don't get a collapse. That's what we can do.
So thank you for those tangible steps. So what kind of, you spoke about like Cyprus and Greece, that there was these type of capital controls in place. Do we have something similar already in place in the United States? Are there, are there things that people should be watching out for, like at their local bank? Or is this, something that's a little bit more hidden that we really can't impact or make a decision to get around?
All right, how deep do you want me to go down this rabbit hole?
30,000-foot view. Let's stay pretty high, because I got some other questions for you.
Okay, good. All right. So the 30,000-foot view is, we had 4 of the largest bank failures happen in the last 6 months. Okay. Mm-hmm. I'll just leave that at that and say, what are they trying to do with that? Well, I believe what they're trying to do is drive banking into 4 very large banks. The big ones. Consolidating. Yep. And the regional banks, if you look at the stock charts, they're all suffering because, well, there's a lot of reasons, but we're staying 30,000 feet. And it's because the Fed has raised rates on purpose. And when they've done that, they've driven their asset prices down. So these banks are now insolvent. So we, the people, are going to have to bail those banks out. That's just little less than 30,000 feet right there.
Okay. Maybe we can go 25 or 20 on this. So some of the things that, our investors have been keeping an eye on is like you said, the Fed rate, so a lot of these banks, to my understanding, please correct me if I'm wrong, the Fed said 2020, 2021, safest place if I'm a bank owner, safest place for my money is to go buy treasuries, right?
Yep.
Right? Okay. And like I said, correct me if I'm wrong here. So the bank goes and buys all these treasuries to hedge their risk, but because they have other assets that are quote unquote riskier on their balance sheet, but treasuries is like the best place to place money. They're earning 1.5%, and then all of a sudden rates go up, and these treasury bonds that they're locked into are only paying 1.5%, but their debt is far outweighs that. So now they're flipped, they're upside down. Is that correct?
Almost. You're 99% there. And to understand the last 1% is, we have to understand how bonds work. When a bond pays 1.5%, it's not as appealing as a bond that pays 5%. So if you're going to spend the same amount of money on a bond, you're going to spend it on the 5% bond and not on the 1.5% bond. So the price of the 1.5% bond is going to go down enough to make it equal the yield of the 5% bond. So when the Fed raised rates on their new money, people were like, I want some of that new money. So the value of the old money collapsed. These treasuries on the balance sheet of Silicon Valley Bank and Signature Bank, some of these other banks that collapsed because the treasury values they had on their books went down. And people like you and me, I was like, Whitney, the bank is a little bit insolvent. Maybe we should pull our money out of there. And we're not lining up in front of banks anymore like we did in the 1930s. We get to call our bank and go, hey, wire my money to Chase today, and your money is gone. And when a bunch of people at the same time wire their money out, the bank goes out of business. That's the last part of it.
Okay, so we've got the bank balance sheet essentially going upside down.
Exactly.
Now, and so I can see how this impacts, companies that are, hugely into tech stocks, maybe some riskier commercial real estate assets. But how does this impact the regional banks? Like, how does this volatility impact them? Because there's a whole contingency, myself included. I love banking at a regional bank. I know the banker, they know me. They know the area where I'm investing, right? So how do you see this progressing to where there's only going to be 4 large major players?
Go try to borrow money from a regional bank right now. It's really hard to borrow money at any bank, really, because the liquidity of the banks has dried up because of the repo market. We're going to stay 30,000 feet, but the liquidity of the banks has now dried up because the money has moved to other places. And so we're getting sell-offs in treasuries. We're getting illiquidity at banks. We're not having that secondary market buy up all the liquidity of the banks that we used to have. And now banks are just like, they're not comfortable lending it because they don't have a lot backing it up. So, and there's a bunch more stuff that goes into that. But but the system is freezing up, right? And so alternative forms of investments in capital are showing up, but they're not really part of the banking system. So
Got it.
there's some different stuff going on. Yeah.
So, okay, so we understand kind of the current Fed policy. We understand why our investors should care about this, right? How to, best protect their money. You gave us some tangible steps. Get into hard assets like real estate, guys. I'm partial, but also because real estate has been my friend through the last 2 cycles. So, I mean, there's a little bit of history here. So what are some other things that people can take into account to help navigate this uncertainty? What are some other things that if somebody's sitting here listening to this and they're just like, okay, I've got my money at, the top 4 bank. I have less than $250,000 in each one of the banks that I'm at in order to have it FDIC insured. I'm, pay attention, I'm well capitalized to keep my own business afloat, my own personal finances afloat, but all my investments are in hard assets. What are some other things they should consider doing?
Well, in my opinion, money shouldn't be held at a bank anymore, because I think we've just started the tip of the iceberg of the bank failures, right? So we're going to see a lot. Yeah, I think that's going to happen a lot in the second half of the year. I don't like making predictions, because then you can always go back and go, you were wrong. But I'm just giving you trends. My feeling is it's going to happen second half of the year. It might happen earlier, it might happen 2 years from now. I don't know. But I think we're at the beginning of the cycle of bank failures. And it happens in all of the economies that I've studied. Is, they go and take the money from where it is, right? Greece and Cyprus included. And so if you keep $249,000 in your bank, well, the FDIC is insolvent, right? They used up almost all of the money bailing out the 4 banks. There's only like 1% left, right? So I don't remember the numbers, because I don't remember those kinds of numbers, because I'd rather remember other stuff. But anyway, it's something like that. And so at the end of the day, the FDIC takes a little bit of money for the banks to fund their insurance program, but we're going to fund it. You and me and all the taxpayers are going to fund this. We're going to fund all this stuff. We're going to fund the pensions as the pensions collapse. The example we just talked about in the bank system, imagine all of these pension funds in California, CalPERS, and all these big funds in Illinois and all that stuff that have invested in treasuries too. We haven't heard anything about that. There's the pension guarantee fund, which is a government fund that is basically illiquid and non-solvent. And so we're going to have to fund that too. They're coming after more of us, asking questions about like, hey, let's come after assets now. That's another thing, is like, if you've got assets, whether you make money or not, they're going to maybe start taxing assets. I know that was floated a year or 2 ago. So we can, I'm getting down the stream here, but it's, don't keep so much money at the banks. Right now, money market funds are paying really good rates. So you can keep some money there. Just kind of spread it around like you've already alluded to, but just know that if they put capital controls on the banks, you're going to have a lot of your assets tied up. I kind of like putting it into cash flowing real estate. I think that's such a great way to hedge your bet. And, hopefully, knock on wood, the property market has not, frozen up. So you'll be able to at least have some quote unquote liquidity there.
So, okay, so 2 questions here, and let's start with the first. Capital control. Like, what are some of the buzzwords that we should be paying attention to as your average listener, to really understand, that what Mark said is starting to happen. Like, what are some things that we will hear in the news or
if you start seeing more bank failures, the age of capital controls is coming. So just know that. You're also going to start hearing more stuff about a federal CBDC, a central bank digital currency. So we're starting to roll out this little cryptocurrency from the government, right? And that cryptocurrency might sound really cool. They're going to put all kinds of marketing buzz around it. There's another side to it, and you get to decide what side you want to be on. But what they've done in China is they've put social credit scores attached to the money. So you got your phone, and if you weren't vaccinated, you didn't get to go and buy the groceries at the store, for example. If you didn't say what the government wanted you to say, you didn't have as high a social credit score as you might have had, if you were, towing the Communist Party line. If you burn a little bit extra carbon because you took a couple extra flights, or your car is a big SUV, you may be rationed on some of your gas. So that's what they're talking about with CBDC. I don't think they're going to come out and do that immediately, but that's the risk, is that everything is now tied to an identity, a digital ID card, and your money. And that's kind of, if you look at the long-term view, if you eliminate banks, or you bring them down to a few 4 controlled banks, and the Fed is really in control of all of the money, some sinister actors could say, we're going to tie the money to a social credit score or something that's politically motivated. And that's something to be careful for. A little bit off your question. I think back on capital controls, you just got to watch out for those bank failures, and just kind of have a tight rein on your money, and invest for cash flow. I keep going back to that, not having a bunch of money sitting in cash.
So what are your thoughts on cash flow life insurance? Infinite banking. Like, if somebody's looking for an alternative place to stash their cash, like, what is your thought? Where does that fit into somebody's plan?
I think I know enough to be dangerous in giving you an answer. I'm probably going to beg off and say I don't know enough to give a decent answer. I think it's probably a valid part of a portfolio. It's just not mine.
Awesome. Okay.
Yeah.
Fair enough. We'll leave it there. And for those of you who are wondering about, cash flow life insurance, if you're here live on Tuesday, June 20th, we will have another conversation on that next week. So sit tight. I'm not going to leave you hanging on that particular question for too long. All right, Mark, you mentioned a couple of things, and there was the scary thing that we're going to come back to that we started off at the very beginning, but you mentioned a few other asset classes, and I'd be remiss if we didn't talk about it. We talk about real estate a lot here. We believe in real estate. But I find it really interesting that you mentioned that stocks, bonds, and mutual funds, as well as Bitcoin, are hard assets, because the last 2 years has showed me anything but. So tell me more. I would love to know more.
Okay, well, gonna have to stay pretty high up on this one too. But I still believe in capitalism, right? Even though I don't think we truly have it anymore, I still believe in the ingenuity of the business person, right? The person on the corner store selling goods, the person at Amazon, the people at Apple. We still need technological innovation. And so to me, those are, I don't want to call them hard assets, but I call them technology assets, let's say, right? Technology always wins. It has always taken societies to their next level of abundance. And it's no different now, right? Look at us 10 years ago, the kinds of phones we did or didn't have, or 20 years ago, we didn't have any internet stuff, no phones, right? And our lives are so much different. I'm not going to say better, worse, but they are certainly more different. And, I'm in Greece and I travel around on a motorcycle, and it's really cool. I'm going to get off here on this, but I'm going to go, I can go to a city, navigate there on a GPS, push a button on, one of the travel sites, book a room, find out where to go see the sites, make a video about it, post it online. And, all that happens on this one little device. That is a big economic stimulator. So the stocks that are behind these companies, or the other way around, the companies that are behind these stocks, are hard assets. So if they're growing their earnings, they're growing their revenues, those are things to invest in. We invest for cash flow. So we're very concentrated on really good quality stocks like Tesla and Apple and Nvidia. And we create cash flow out of those assets. My dad taught me about real estate when I was young. He also taught me about stocks. He made a ton of money in real estate. And I got the bug, but you know what? Real estate doesn't move enough for me. You got to get it appraised, and you got to get it inspected and mortgaged, and all that takes too long. I can click a mouse and invest 100 grand really quickly. And I can also create 1 to 2% of income every week. So that's how I cash flow with those kinds of assets. Now, if you were in the market in the last couple of years, you got some buying opportunities, let's call it that, right? Because we sat through a bear market from the end of 2021 until the beginning of this year. And so here we are sitting in a bull market, and we're at the beginning stages of the bull market, if you believe what I said at the top of the call. And that is that the Fed is going to crank up the printing press again, because they gotta print more money to pay that debt. And that's going to put more money into the economy, and it's going to make an inflationary boom again. And that's going to affect stocks. So stocks, bonds, mutual funds, I don't know if I go that far. I believe that you concentrate within an asset class and you diversify among asset classes. So I concentrate very deeply on some really good quality companies and create cash flow. And it's the same thing that you would do in real estate. Like, you're not going to buy self-storage and apartments and houses and, sixplexes. You're going to probably focus on, I'm really good at strip malls, and that's what's going to bring you in your cash flow. But I believe in Bitcoin as an insurance policy as well, and gold, for a lot of other reasons.
So why is Bitcoin considered an insurance policy?
For me. So most people are like, what's Bitcoin worth today? I'm like, I don't care, because I believe that Bitcoin in 5 to 10 years, because there is no reign on fake money, whether it doesn't matter what central bank we're talking about, Japan, China, ECB, the US, we have no tethers on printing fake money and thrusting it out into the economy. And now we're doing it at a faster and faster rate. I mean, the statistic probably that in the last 2 years, we've printed more money than we ever had in the history of the whole United States. And so that kind of irresponsibility is going to create a scarcity for hard money, whether it's gold, silver, platinum, Bitcoin. Bitcoin's got a scarcity component because it's only going to be 21 million Bitcoins ever printed or ever made. And that's the limit. So per dollar, if you measure it by the denominator, that has to go up. So mathematically, in my opinion, it's an insurance policy against this fiat system, and the fiat system has no other choice but to continue to do what they've already done.
Well, Mark, I want to make sure we leave plenty of time for our question and answer session for those people who are here live. Guys, we've had an amazing conversation here. You guys should go back and listen to this again if you've wanted an understanding of how the Fed impacts the dollar and the volatility, and how to navigate that volatility in today's environment. Listen to this over and over. The cool thing is the tips that Mark shared today doesn't just apply to today. These are tips that would apply to pretty much any inflationary cycle and how to navigate that environment. Mark, again, thank you.
Sure.
Where can people find out more about you?
Well, you can listen to my podcast, wealtharchitectpodcast.com. I'm on YouTube under that name, but I also have a program called the Cash Flow Machine. So you can go to cashflowmachine.io, and we talk about how to make reliable income from the stock market, if that's kind of your thing. So those are probably a couple good places. I'm at Mark Yagi all over the place on Twitter or wherever you want to find me. So love to hear from you.
Awesome.